There are two types of people in crypto right now. The first group is quietly building life-changing wealth. They're not loud. They're not constantly posting screenshots. They're not reacting to every headline. And then there's the second group, the ones who will still be broke in the next bull run, scrolling through social media, watching other people celebrate, and asking the same question they asked last cycle. What went wrong? Here's the uncomfortable truth. The difference between these two groups isn't luck. It isn't secret insider information. It isn't perfect timing, and it definitely isn't intelligence. Before we go any further, make sure you like the video and subscribe to the channel if you want more content focused on strategy, psychology, and long-term wealth, not hype. Because while billions of dollars are flowing into crypto from institutions, while governments are building regulatory frameworks, and while the next major wealth cycle is quietly forming, most people are positioning themselves to lose. And here's the twist. The people who lose in crypto usually aren't the ones who get hacked. They're not always the ones who fall for scams. They're not even necessarily the ones who pick terrible projects. They're the ones who follow the crowd. If you're doing what most people are doing right now, chasing hype, checking charts every 5 minutes, jumping between coins, reacting emotionally, you're not building wealth, you're participating in noise. Quick disclaimer, this is educational content, not financial advice. Always do your own research and never invest more than you can afford to lose. Now let's break down the 3 rules that actually give investors a real edge and separate long-term wealth builders from everyone else in this space. Rule number 1. Stop chasing, start positioning. Let's start with a mistake almost everyone makes. Most people enter crypto because something is already moving. They hear about a coin after it's pumped 200%. They see screenshots of profits all over social media. They feel like they're late. They feel pressure. They feel FOMO, and that emotion pushes them into action. So they buy. And what usually happens next? The market pulls back. Not because the market is targeting them, not because they're cursed, but because they're reacting to attention instead of anticipating it. Here's what winners understand. By the time something is trending on TikTok, YouTube, X, Instagram, the smart money is already positioned. Retail attention does not move markets. Positioned capital moves markets. When you buy something because it's popular, you're not early. You're liquidity for someone who was early. And that's a hard truth to accept. Real wealth in crypto isn't built by chasing pumps. It's built by positioning before attention arrives. That means studying narratives before they're mainstream, watching where liquidity is quietly flowing, paying attention to infrastructure developments, regulatory shifts, macro conditions, not just price charts. It also means being willing to buy when things feel boring, and this is where most people fail. Buying when nobody is talking about something feels uncomfortable. Holding when nothing is happening feels frustrating. Ignoring hype feels like you're missing out. But that discomfort is the entry fee for real opportunity. Because the majority of people only act when emotions are high, and when emotions are high, opportunity is usually low. Think about every major cycle. The biggest gains didn't happen when everyone was confident and euphoric. They happened when sentiment was negative, when the media wasn't paying attention, when patience was required. Winners don't wait for confirmation from the crowd. They position before the crowd arrives, and when the crowd finally shows up, they're not scrambling to buy. They're deciding whether it's time to reduce exposure. That's the shift, from reacting to anticipating, from chasing to positioning. If you master that, you've already separated yourself from the majority of the market. But positioning early is only half the equation, because the second rule determines whether you actually keep what you build.
Rule number 2, conviction beats constant switching. There's a destructive pattern that almost every retail investor goes through. They buy a coin. It doesn't move immediately. They start doubting it. They see another coin pumping. They feel like they're missing out again, so they sell their position and rotate. Then the coin they sold pumps, and the new one stalls, so they rotate again. Over time, their portfolio becomes a graveyard of bad timing and emotional decisions. Constant switching feels productive. It feels like you're adapting. It feels like you're doing something. But in reality, it's often disguised impatience. Winners don't operate like this. They don't jump into every new trend. They don't abandon positions because of 2 weeks of sideways movement. They don't treat boredom as a signal to exit. They build conviction. And conviction doesn't mean blind loyalty. It means having a thesis. It means knowing why you entered, what conditions would validate your thesis, what conditions would invalidate it, and what time horizon you're working with. Without a thesis, you're guessing. With a thesis, you're investing. In crypto especially, real gains often come from holding through boredom, not just volatility. Most people can handle volatility. They can handle price moving up and down, but they can't handle silence. They can't handle 3 months of nothing happening. That's when doubt creeps in. That's when they start questioning everything, and that's when they abandon positions right before momentum returns. Conviction allows you to stay positioned long enough for asymmetry to play out. Because let's be honest, the majority of meaningful gains in crypto don't happen gradually. They happen in bursts. Sharp repricings, sudden liquidity rotations, narrative shifts that compress months of movement into weeks. If you're constantly switching, you're rarely positioned when those bursts happen. Meanwhile, the disciplined investors are quietly compounding. They're not reacting to every tweet. They're not making decisions based on someone else's excitement. They're not chasing every new shiny object. They're letting time work. And time is one of the most underestimated edges in crypto. Everyone wants speed. Very few people are willing to sit still. If Rule 1 is about positioning early, Rule 2 is about staying positioned long enough for it to matter. But there's one more rule, and this one might be the most important of all.
Rule number 3. Treat crypto like wealth, not entertainment. This is where most people sabotage themselves without realizing it. They say they're investing, but they behave like they're gambling. They wake up and check prices before brushing their teeth. They refresh charts during conversations. They measure their mood by their portfolio. Every small move feels urgent. Every dip feels catastrophic. Every pump feels like validation. Over time, crypto stops being a financial tool and becomes emotional stimulation. And that's dangerous, because once your decisions are emotionally driven, you become predictable, and predictable investors are easy to shake out. Winners don't treat crypto like a game. They treat it like an asset class. That means clear allocations, defined strategies, predetermined risk levels, emotional distance from short-term noise. They don't need constant stimulation. They don't need to watch every candle. They don't need to react to every headline. In fact, some of the most successful investors spend less time looking at charts than beginners. Why? Because once your strategy is defined, excessive monitoring doesn't increase returns, it increases stress, it increases impulsive decisions, and it reduces clarity. Treating crypto like wealth means zooming out. It means understanding that real financial change happens over cycles, not days. It means recognizing that volatility is part of the process. It means separating your identity from your portfolio. If your mood rises and falls with price movement, you're vulnerable. If your confidence disappears during drawdowns, you're exposed. If your excitement peaks during pumps, you're likely to overextend. The market feeds on emotional extremes. Discipline protects you from them. When you shift from entertainment to intentional investing, everything changes. You stop overtrading. You stop reacting to noise. You stop feeling the need to do something every day. And instead, you focus on doing the right things consistently. That's the real edge. Bringing it all together. Look at the majority of participants in crypto right now. They're reacting, chasing, switching, obsessing. They're busy, but they're not effective. Meanwhile, a smaller group is operating differently. They're positioning early before attention arrives. They're holding with conviction instead of constantly switching. They're treating crypto like a long-term wealth-building tool, not a dopamine machine. Those are the people quietly building leverage. And here's what most people won't realize until later. The next major wealth wave in crypto won't reward the loudest voices. It won't reward the most active traders. It won't reward the people glued to charts 24/7. It will reward the most disciplined participants, the ones who understand that success in this space isn't about doing more, it's about doing the right things consistently. So ask yourself honestly, are you positioning or chasing? Are you building conviction or constantly switching? Are you treating crypto like wealth or entertainment? Because the gap between those two approaches widens every cycle. And the people who develop the winner's edge now are usually the ones everyone else studies later. If this shifted your perspective, make sure you like the video and subscribe. I focus on strategy, psychology, and long-term positioning, not hype or short-term predictions. And I want to leave you with this. Information alone doesn't create an edge. Action does. The market will keep moving. Cycles will keep repeating. Opportunities will keep appearing. The only question is whether you'll move through them like everyone else, or with the clarity, discipline, and intentionality that actually builds wealth. Your move. If you enjoyed this video, don't forget to like and subscribe, and I'll see you in the next one.